Good afternoon, ladies and gentlemen. Welcome to Free Information Friday, and I'm hyped to be discussing the topic of passive losses in real estate. First, let's define what a passive loss is. A passive loss occurs when the expenses from your rental property exceed the income from that rental property. When not materially participating in the management of the rental property, the passive loss rule comes into play, which essentially classifies your rental activity as a passive activity. And here are three things that could happen in that scenario. Number one, offsetting passive income. You can use the passive loss to offset passive income in the year that the loss is incurred. The passive loss could be income from another rental property or from a limited partnership. Number two, carrying forward the losses. Now let's assume in the year that you incurred the loss, you had no passive activity to offset those losses against. So that loss would get carried forward to future years where you could use it to offset passive income when it occurs in those future years. The third thing is disposition of the property. When you go to sell the property, you can utilize those loss carryovers to offset any gain that might result from the sale of that property. However, there is a special rule that does apply. It's called the special allowance. In order for this special allowance to come into play, two things have to happen. Number one, you have to have materially participated in the rental activity. Number two, your adjusted gross income has to be within certain ranges. And I'll go over those ranges now with an example. Let's say that your adjusted gross income is $90,000 for hypothetical purposes. And let's say that your rental property incurred a $25,000 loss for that year. And based on the special allowance, if your adjusted gross income is less than $100,000, you can write that whole $25,000 loss in that year against your ordinary income. However, let's say that your income is between $100,000 and $150,000. That is basically the phase-out period, writing off losses. In that situation, let's say you had that same $25,000 loss. Okay, keep that in mind. Now let's say that your adjusted gross income was $120,000. So your adjusted gross income was over the threshold of $100,000 by $20,000. Your $120,000 adjusted gross income less the floor for the special allowance, which is $100,000. The special allowance says that for every dollar that your adjusted gross income is over $100,000, you have to reduce your loss by 50 cents. So let's say that your gross income is at $120,000. Multiply that by 50 cents, that's $10,000. The result of that is that $25,000 loss that you had is going to be reduced by $10,000. So in that year that you incurred the $25,000 loss, you're only going to be able to write off $15,000 of that loss. Now, the $10,000 that you were not able to write off doesn't go away, does not go away. It gets carried over, as I mentioned in the previous segment, so you didn't lose it. And the last situation that could occur with the special allowance is that your adjusted gross income is over the $150,000 mark. In that situation, that $25,000 loss that you incurred, you would not be able to write one penny of that off against your ordinary income that year. That whole $25,000 would become a carryover loss that you can utilize in future years when in fact you do have passive income to offset that by. Now, I'm hoping that you got a good understanding how important passive losses are within the framework of real estate. If you have any questions or need help, please feel free to reach out. And if you're a real estate investor who wants to maximize the return on investment through expert tax strategies, please book a call with our firm. And remember, only you can create your empire, but we are here to help every step of the way. Thank you, and I wish you much success